Today, let's talk about why keeping it simple with price action is the best way to trade. Check out this chart. It's packed with confusing indicators. Using too many of these extras can mess up your understanding of what's happening in the market. Some traders might think trading without indicators is impossible, but trust me, it's not. I do it every day and it makes a huge difference. Now, imagine I ask you which chart you'd prefer to analyze. This one with all the mess or this clean one? You'd probably pick the neat chart, right? It's way clearer without all the confusing stuff. Removing those extra indicators makes it much easier to figure out what's going on. So, whether you're just starting or you're already good at trading, but struggle with charts, just use a basic candlestick chart. Get rid of any unnecessary extras like useless indicators, and you're good to go. You'd be surprised at how much a simple candlestick chart can tell you. Take a look at this chart. Understanding market direction can be simple if you pay attention to swing highs and swing lows. Despite its simplicity, many traders overlook this basic data, often searching for complex explanations where none are needed. All the information you need is right here. Don't ignore what the chart is telling you. Take a look at this chart example. The bearish moves are stronger than the bullish ones, indicating bearish dominance. The chart shows lower lows and lower highs, meaning sellers are in control. Now, look at another chart. This one clearly shows a ranging market, where swing highs and lows stay within two major boundaries. The market is consolidating in a sideways pattern until it breaks through the boundaries. Identifying ranging markets is straightforward. It's just two levels the market is stuck between. Sometimes there are attempts to break out, like in this example. However, these attempts can fail and prices fall back into the range. Price action traders call these false breakout traps, and you can use them to trade ranging markets. Wait for the market to reach support or resistance, then watch for a false breakout. Here's a clear false breakout entry setup, and another one here. Sometimes the market is unreadable, and that's okay. Traders often try to make sense of everything, even the noise. In this chart, it's a noisy and hostile market, lacking structure, trend, or clear range, a choppy market. Don't navigate these waters. It's a no-fly zone. Many traders lose profits in these risky conditions. Here's a pro tip. If you open a chart and can't see clearly what the market is doing, just ignore it. Stick to clear charts where you can make money and avoid unreadable ones. It's as simple as that. Now, look at this chart. Take a look at the market. It's on an upward trend, meaning buyers are in control. Professional traders often say, the trend is your friend, so following it means you're on the right track. By checking the chart, you can see higher highs, higher lows, and moves followed by corrections. It may sound basic, but it's crucial. In an upward trend, we look for buying opportunities. Now, observe what happens next. The market breaks the resistance level, pulls back, and then forms a strong pin bar signal. This signals the end of the pullback, suggesting a new upward move is likely. And as you can see, the market keeps going up. Let's consider another example. In this upward trending market, the resistance turns into support after a breakout, giving us another chance to join the trend. When the price pulls back to retest the support level, it's rejected, forming a nice doji candlestick pattern. A doji suggests a pause in the market. After a pullback, it signals that sellers failed, and buyers are likely to push the market upward. That's exactly what happens. The market goes up again. It's as simple as that. Instead of using complex indicators, we rely on simple price action concepts like market structure analysis to understand whether the market is going up, down, or ranging. Candlestick patterns like pin bars, doji, and engulfing bars help us time our entries. Let's look at real chart examples. In this chart, the market trends up, breaks the resistance turned into support, and upon retesting, a bullish engulfing bar forms. This indicates buyers are in control, and there's a high chance the market will keep going up. Consider another example. The market trends down, showing that sellers are in control. The support level becomes resistance, and upon retesting, a pin bar forms, suggesting a new downward move is likely. Look at one more chart. Here the market is ranging, with no clear control. As a price action trader, focus on boundaries. When the market reaches support, wait for a candlestick signal to form before entering, and do the same at resistance. Using indicators can be confusing, especially if you use many. However, using one indicator you understand well can help filter trades. For instance, I use the 8 and 21 simple moving averages to find dynamic support and resistance. Consider this example. In a downtrend, once the price hits the 21 simple moving average, it's rejected. Using these moving averages alongside candlestick patterns and market structure helps find high probability setups. As seen here, rejection at the 21 moving average provides trading opportunities. Using indicators as tools, not signal generators, can enhance your decision making. Now examine another example. In this market, the trend is upward. When the price hits the 21 moving average, it's often rejected, forming a pin bar entry signal. Another opportunity arises with an engulfing bar signal. Combining price action with the 21 moving averages offers excellent trading chances. To be a successful trader, let go of the misconception that more indicators mean more money. Instead, focus on making your charts clearer for better trading decisions. I hope this video has taught you something new. Don't forget to like and subscribe to the channel for updates on new videos. Thank you for watching.